Every time you chase a breakout, there is someone on the other side setting a trap. They know where your stops are, they know where your entries are, and they use that information to take your money before reversing the market in the opposite direction. This is called a liquidity sweep, and it happens thousands of times a day across every single market. But what if instead of being the trader who gets trapped, you become the one profiting from the trap? That's exactly what turtle soup does. By the end of this video, you're going to know exactly how to spot these traps before they happen, when to enter with precision, and how to target the opposing liquidity for consistent wins. And stick around to the end because I'm going to share the one entry rule that separates profitable turtle soup traders from those getting stopped out. It's the 10 to 20 point buffer that changes everything. Let me take you back to the 1980s, where Richard Dennis taught traders to buy breakouts, specifically when price broke above the 20-day high. Yep, it was that simple. And it worked wonders way back then. But the game has completely changed. Today, those same breakout levels have become traps. Algorithms and smart money knows exactly where your orders are. Just beyond every swing high, there is a cluster of stop losses from short sellers and a wave of breakout buyers ready to jump in. So they push price enough, just enough, to trigger all those orders, and then they reverse the market in the opposite direction of the breakout. That's the trap, and that's what turtle soup exploits. Linda Raghee, one of the most respected traders in the business, named this strategy turtle soup because it literally made soup out of breakout chasers who get caught on the wrong side of the move. It is pretty savage if you ask me, and she is. This is powerful because you're looking at an 81% win rate. Plus, you're entering at the extreme of the move with a tight stop, so your risk-reward ratio is consistently about 3-to-1 or better. Now, I know what you're thinking. 81% win rate? That sounds entirely too good to be true. It is, but here's why it works. Instead of predicting what the market will do, you're reacting to institutional behavior that repeats in the same way again and again every single day. I've been trading turtle soup for years, and I've watched hundreds of students go from breaking even to consistently profitable once they understood this structure. But you just can't short every breakout and hope for the best. There's a specific three-phase structure that has to form first. And if you don't know what to look for, you could still get wrecked. Every turtle soup setup follows this sequence. And once you understand it, you'll start seeing it everywhere. Phase 1 is the accumulation. Price consolidates in a tight range, usually during the Asian session or even US pre-market. Really, it's any low volume period. The algorithm is building positions on both sides of the market. That's what it does. You'll see clean equal highs and equal lows forming. In other words, a channel. These are not random. They're engineered to attract stop losses just outside those obvious boundaries. Traders look at this range and think, okay, if price breaks above these highs, I'm going long. If it breaks below the lows, I'm going short. That's exactly what smart money wants you to think. Phase 2 is manipulation. This is the trap. Price breaks out of the accumulation range, usually in the direction opposite to where it's actually going. This is called oftentimes a Judas swing. And this is where retail traders get destroyed. The breakout sweeps the liquidity on one side. Stock losses from short sellers get triggered. Breakout buyers rush in, and the market looks like it's breaking out and ready to trend higher. But in reality, this is smart money offloading their positions with next to no slippage. They're harvesting stops to fuel the real move. In other words, they're using the liquidity. This phase is your signal zone to get ready. Phase 3 is distribution. Finally, when liquidity is absorbed, in other words, those orders are filled, the market reverses sharply. Price races towards the opposite end, the opposite liquidity pool. That's the other side of the accumulation range. The move is so violent because the trapped traders become the fuel for the reversal. Now, most traders understand this, but when it's time to pull the trigger, they freeze or they enter too early and they get stopped out. That's the exact execution gap I close in on in mentoring sessions. We review your actual charts, your actual entries, and I show you this was the trap, this was the confirmation, this was the setup, and this is the price you enter. The link is in the description below. But knowing the structure isn't enough. If you enter too early or in the wrong place, you're still likely to get stopped out. So let me show you the exact entry rule that keeps you on the safe side more often than not. All right, so you've identified the three-phase structure. You've spotted that accumulation range, which is just a sideways range. You've seen the manipulation sweep the highs or lows. Now comes the most important part. When to actually enter. So here's the golden rule. You wait for price to come back inside the range by 10 to 20 points before you enter. Now keep in mind, 10 to 20 points might work really well for the Dow or the NASDAQ. It might be fewer points, say 3 to 5 points for the S&P, or fewer yet for gold. Just remember, you want to make sure that the breakout high is pausing and starts to sink back into the range. Let me break this down with a real example. Let's say the range high is at 15,000 and price sweeps to 15,010. This triggers the stops and the breakout entries, but you don't enter yet. Instead, you wait for price to drop back down to 14,990, 14,995. That's your move back inside the range, and that is your confirmation that the breakout has failed. Pro tip, you can look for a minor high or inside candle confirmation as well. At this point, the trap is complete, which brings me to the 50-point rule. If price trades 50 points beyond the sweep level and hangs out there, it's not turtle soup. It's a genuine breakout. Now keep in mind, once again, 50 points is relative to the market that you are trading. If it's a stock, look for the typical price range. If it's not a stock that trades at a high valuation, that might be 20 to 40 cents. That might be less than $1. If it's the Dow, again, that 50-point rule would work really well. For the S&P, you want to probably keep it between 3 and 5. Real manipulation doesn't give you time to think about it. It spikes, it grabs liquidity, and it reverses. This is why an inside candle or a minor high candlestick pattern can be great confirmation. Now, once you're in the trade, your stop loss should be placed 20 to 30 points from your entry. Again, remember the symbol that you're trading. We're talking about an average amount of movement that shows price is fairly range bound, not that it's breaking outside of its normal volatility. Your target is the opposing liquidity at the other end of the accumulation range. If that range is wider rather than narrow, you can even use what's known as a halfback, which is halfway to the other side of the accumulation range. If you shorted a sweep of the highs, you're targeting lows where all the sell stops are sitting. This is what gives you that clean 3-to-1 risk-reward ratio. Perfect. You got the structure and the entry golden rule. You're thinking about the average price movement of the symbol you're trading. You could stop here and start trading turtle soup profitably, but there's one more layer that takes us from a good strategy to downright being an unfair advantage: timing. The highest probability turtle soup setups happen during what we call macro windows, specifically 9:50 to 10:10 a.m. and 10:50 to 11:10 a.m. Trade during these windows where institutional activity is concentrated and your win rate will spike. These are also known, by the way, as day trading clock reversal times. Now remember that point buffer, depending on the symbol that you're trading, that I promised you? Most traders see the sweep and they enter immediately, and then they watch price run another 40, 50 points against them. That hurts. The buffer is your confirmation. It proves the trap is complete and the reversal is real. Again, remember, this can be a minor high pattern or an inside candle as well. Without it, you're gambling, but with it, you're trading with precision, and profitability will be pretty much inevitable. Turtle soup works because it's built on the one thing that never changes in trading or in humans: liquidity. The idea is to understand how institutions play the game, to stop being liquidity and start profiting from that flow. Now, if you want to take this further and learn how to apply turtle soup across different time frames and different market conditions, as well as different markets, that's the tip of the iceberg of what I cover in my live trading room. This is where I help you identify your mistakes, refine your execution, and help you build a system that actually works for you based on my 38 years of trading. And if you're still watching videos trying to piece all this together, I've got another one for you that's going to show you how to stack the odds even further in your favor. You don't want to miss it. I'll see you in the next one.